Disney just reported their Q1 earnings, the first time after Bob Iger returns back to the company. We'll go through the financial results on today's video. What is going on, investors? Hopefully, guys are doing well out there. Time to talk about the Walt Disney Company, ticker symbol DIS. Over the last year, stock's down about 21%, but year to date, oh my goodness, everything's up. This one's up about 25%. We'll go through the Q1 earnings, which came out after the bell. We'll also cover on today's show. We'll look at kind of forward revenue estimates for this company going forward. A lot of news with this company. Obviously, kicking out Bob Chapek. I mean, that guy absolutely sucked. And so it's good for Disney and good for Disney shareholders that he got the boot. And it's lucky for Disney that they have a former CEO that had a fantastic track record willing to come back. He says it's for 24 months. We'll see if it ends up being a little bit longer than that. But he says he's in it for 24 months. My guess is you'll hear a succession plan within the next 12 months or so. And so we'll see how that develops. But a lot of other news related to activist Nelson Peltz, a board shakeup and kind of reshuffle over at Disney. There's certainly more news coming for that as well. Bob Iger already kind of putting his fingerprint on this company. It's not quite the quarter where he's had full control over everything, but we're starting to see some interesting things that Bob Iger is potentially going to bring down the pipe for Disney investors. We'll come over here and look at this from a financial perspective. It's been a tale of two stories. If you've been following our channel for any length of time and watch our videos, well, you know, look, you have the media division, the TV, the ESPN, the direct to consumer, and then you got the parks. And it's been two completely different stories. And in my opinion, Bob Chapek actually did a very nice job on the parks, but he was a complete disaster on the media division. And so if Bob Iger's able to kind of balance the two, well, certainly Disney could have some great performance going forward. We'll take a look at the financials from a broader perspective over at Disney, and we'll look at this from a technical perspective. I'm seeing in the after hours, stocks up about 3% as that conference call likely getting underway. My guess is Bob Iger is going to sweet music to investors on the conference call. Revenue came in at $23.5 billion. That was up 7.7% year over year. It beat expectations by about $230 million. And look, it gives us we don't get like a clear Q1 guidance or Q2 guidance in this case for Disney. We don't get clear guidance for that. But I tell you what, when you put up $23.5 billion, Wall Street's high-end estimate was 23.96. So they came in very close to that high-end estimate. So that is going to give Wall Street a lot of confidence that Q2 is going to look pretty good and Q3 and Q4. So you're going to have a decent revenue growth over at this company, especially one of this size. Now, obviously, we talked about how Bob Iger is back. Chapek got the boot, and that was the right decision for Disney. If you've been following this company over the last year, it's just been a disaster. They made the right move. They brought back in the right guy. And certainly if Bob Iger is going to be able to pass the torch to somebody, that would be even better for Disney. Now, activists are lining up because they see the torch being passed over at Disney and they want to line up and have a decision in that. Nelson Peltz has a large position in Disney and a long track record of actually creating shareholder value. And so obviously he's going to come in there. He wants board seats. He probably wants a decision on who gets the next CEO job over at this company because he saw how bad the last one went. So he wants to have maybe a little bit decision making in that. The company, in terms of Disney, they're going to fight back against this. They appointed former Nike CEO Mark Parker as now the board chairman. They are going to urge shareholders to vote against Nelson Peltz. We'll see how this ends up. Ultimately, though, these types of things ultimately do actually pretty well, in my opinion, for shareholders, because whether or not Nelson Peltz gets his way, he's going to keep Disney on their toes. He's going to force them to maybe do things a little bit tighter than they would have without him there. And so I actually like this development. Whether it doesn't really matter, I don't think, which way it goes. Disney's ultimately likely going to get their way and appoint the CEO and leadership that they want to, but it might have them reevaluate some of their strategy. And certainly as we roll through this, we'll talk about that more. Now, here's a strategy change. Disney could license content to rivals as a part of Iger's new company direction. Now, the company used to do this, okay? When Netflix was kind of scaling up their streaming platform, that they licensed a ton of content from Disney. And so obviously, when we come over here and look at the financials, you will see off of $5.3 billion worth of direct-to-consumer revenue, the company lost $1 billion. And that was actually a bigger decline than last year. On 13% higher revenue, you actually lost even more money on that. And then when you look at kind of the subscriber base, it's gone flat. And so they're going to have to pull a Netflix and figure out how to reaccelerate this. If you reaccelerate, you're probably going to have to invest a lot of money in that. The other way to do that is maybe just leverage the content that you have and monetize it in more ways. There's all these streaming companies out there. There's all these linear networks that would love to license Disney's content, and that could be a strategy for Disney to unlock some value. Now, speaking of unlocking value, you got the World Wrestling Federation, or actually I think it's the WWE now, showing my age a little bit, but this company appears that they're going to sell over the next couple of months. Disney likely a player in this in terms of actually buying the company, because you're looking at a company right now, and I'm talking about the WWE, worth about $6.7 billion. My guess is in a takeover, you might have to come close to 8, maybe even as high as $10 billion on some kind of takeover. Well, the Walt Disney Company is worth over $200 billion. So it's something that they absolutely could absorb. The other thing that it might do is it might force a competitor to make a move that doesn't have quite the balance sheet or the market cap that a Disney. So a Netflix comes in, or Comcast, or somebody else has to make a big play for WWE. And while I think it's probably a fantastic asset to own, we'll see what happens here. The other thing that it could do is just kind of elevate the valuation or elevate the awareness around content valuation. When a property like the WWE sells for, we'll call it $7, $8, $9, $10 billion at some point over the next 3 months, well, it has you start to evaluate other type of content assets as well. Now, potential for Disney could be spinning off the ESPN network. It obviously comes with some challenges. I've actually published an article here on Seeking Alpha about this. It was actually one of my most viewed and read articles on the site. And I say, look, you've got Apple, you've got Amazon, you've got Google, all bidding on these sports rights in different ways. And it's just driving up the cost. And it's just going to continue to get higher and higher. And if you're not making money right now, really, on the linear networks, and these sports rights are just chewing into the cost, well, I tell you what, spinning off ESPN could be a great move. And I tell you what, you've got Amazon, Google, and Apple that might actually be potential bidders for that asset. Maybe not for the whole thing, but maybe they want to own a portion of it and roll it up into their content strategy as well. We'll certainly see what Disney decides to do. If they decide to spin off ESPN, could create a lot of shareholder value, especially when we roll through these results. Now, again, it's the tale of two different companies over at Disney. You've got the Disney Media Division churning out $14.8 billion worth of revenue. That's essentially flat year over year. But here's your operating income. Here's your media division. It lost $10 million last year. It squeaked out just $800 million. So it's a break-even business, okay? And primarily due to rising content costs. And I don't think the content costs are going down, particularly when you have Amazon, Google, and Apple starting to drive the cost of all these types of things. We're not just talking about sports assets, okay? Movies, TV shows, all those types of things. These companies are all investing in this, and they don't have to necessarily show a profit on these things, at least in the shorter term. Now, thank God for Disney, we got these Disney parks and Disneyland. Look at off of $8.7 billion. That was 21% growth over at Disney. And so that's the other question is, can Disneyland and the parks that they have in Disney World and all across the world, can that continue to accelerate? Okay, because it has been on fire as people were locked down, obviously in 2020, 2021, and your kids only get older, as I know. You're going to want to take them to Disneyland before they become teenagers and don't even want to talk to you. So look, I don't know if this is going to be able to continue to accelerate, but look, it has, and it's done this over the last several quarters. And the great thing about the Disney parks is it's literally just a printing money machine. Off of $8.8 billion worth of revenue, you had over $3 billion worth of operating income. So your revenues grew 21%, your operating profits grew 25%. Now, you kind of have to parse the linear networks or the TV media business kind of into two pieces. So you have your linear network that came in at $7.3 billion. That actually did okay. Your revenues declined 5% year over year, and your operating income declined 16%, but it's still positive, okay? Off of $7.3 billion worth of revenue, you had about $1.3 billion worth of operating income. It's still that direct-to-consumer business that was all the hype over at this company and all the rage. It's been a disaster, okay? Revenue's up 13% year over year. I'll show you that it's primarily due to just raising the cost. It's not due to a lot. In fact, you had a decline in Disney Plus subscribers year over year. So your revenue growth isn't really from a user perspective. It's really from a price increase. And look, you lost money, okay? Off of $5.3 billion worth of revenue, you lost $1 billion. So it's just not a great business. Even the content sales and licensing and other off of $2.5 billion worth of revenue, you lost money there. So again, it's basically a break-even business on that side, and the parks are paying the bills over at Disney. And I talked about how it's turned into basically a no-growth business. So investors have to wonder, is Disney going to be able to because they've got to reaccelerate the subscriber growth. When you're not making money on this, you've got to grow the subscriber growth. And we're seeing year over year, you're not growing Disney Plus, and the rest of them are just growing very low single digits, essentially flat from a rounding perspective. What they are growing and they're trying to push is the ARPU, or the amount of money. And I think they're running into problems there over at Disney. And so you've got to start potentially cutting costs or reevaluating the strategy, as you just simply cannot burn through $1 billion worth of operating profits in a quarter. We're talking about a full year in a quarter on a business unit that appears, at least right now, to be topping out from a demand perspective. Now, you look at the whole totality of Disney. It's still a great business, okay? Off of $23.5 billion worth of revenue, we had $21.5 billion in costs. Okay, this is not a tech company or anything like that. This is why tech is getting into this business, because they're the only ones that can afford these types of investments and get them by investors. It's simply very difficult, okay? You have some other costs at the company, and you essentially pull down to a net income number of about $1.3 billion. That was higher than we were a year ago. Again, all due to the fact you have strength in Disneyland and those types of things. Come down here to the balance sheet. Company has plenty of runway. That's why investors are excited about Bob Iger coming back, because he's the one that could potentially, spin this company back up into printing way more than $1 billion in quarterly profit. I think investors want, maybe $2-3 billion of quarterly profit, and this company stock would perform very, very well if that is the case. Now, some of it is being front run a little bit, as you have this year-to-date performance front running Bob Iger being able to execute on some of these types of things. They've got plenty of cash. Sure, they have debt, but boy, they have all these assets, the park assets, the content assets. That is where the, essentially the balance sheet lies. So when you look at this company and you see, 20 some odd billion dollars in cash offset by 45, call it $50 billion worth of debt. Well, look, they have the parks and they have the content assets. That stuff is worth, tens of billions of dollars. From a cash flow perspective, paints kind of an ugly story. Pull down the slightly higher net income number, and after all your add backs and subtractions, you actually lost more on an operating cash flow basis. You lost $209 last year. That accelerated to $974 million. The one rub about the parks, it's not like it just prints money without any type of investment. No, you do have to spend, about $1 billion a quarter in terms of upgrading those types of things, maintenance, adding new attractions. But even offset by that, you're just printing large amounts of operating profit to the park side on a quarterly and obviously a yearly basis. The rest of the cash flow is simply the company kind of borrowing money, paying it back, those types of things. They burned through about $3.1 billion in the most recent quarter. Obviously, an activist investor is going to want that to improve as well. I'm seeing this stock is popping in the after hours. In fact, we've gotten over a key resistance area. This stock, for the longest time, and we were talking about 5 or 6 years or so, it really traded in a range down here to, we'll call it $90 per share, all the way up to here to about $120. Anywhere in this box has actually been a decent time to accumulate shares. Outperformance occurs when you get above 120, and that's what I'm seeing in the after hours. Stocks up 9%. I figured Bob Iger would get on that call and just sing Frank Sinatra ballads and get people loving what he is talking about. Momentum clearly back on the side of Disney. You could put if you bought shares more recently, you could put a stop loss somewhere just south of maybe like at 115. You wouldn't want the stock to get back into this sideways consolidation. You get back into the sideways consolidation, you run the risk of coming, almost all the way down or very significantly back down to the bottom. But the momentum is back in this stock. The momentum from new leadership perspective, momentum even from an activist investor, whether or not he gets his way or what happens here, that still allows for some momentum. He's not really like selling his shares or selling his stake. And the confidence that investors have that this company is going to meet these revenue targets, and on top of that, address the real issue with this company, the fact that their media and TV business simply doesn't make money and is turned into kind of a no-growth business and somehow deal with this streaming business, which got a lot of publicity and a lot of press for the company and is an interesting part, but is still losing quite a bit of money if Bob Iger is able to turn this around. And then on top of that, pass the baton onto somebody that investors have confidence in. Well, Disney is probably going to be a winning stock. Over the last 5 years, this stock is basically flat, just up 8.5%. But if Bob Iger comes in and gets the job done, this company is likely to outperform over the next 5 years, as it's likely underperformed over the past 5. Hopefully you guys enjoyed today's video. Back again soon with more. Good luck with your investments.